The Microsoft stock, MSFT, is currently trading at $494.60 USD, reflecting a daily loss of negative $12.89, which translates to a negative 2.54% drop in intraday movement as of the market open. Now, the common expectation is that a major tech pullback like this, especially following a brief rally period, is just sector rotation or the market catching its breath after the last earnings spike fueled by the AI narrative. And while that's partly true, the deeper reality you need to consider right now is that this specific pullback isn't just about general profit-taking. It's being driven by a combination of new regulatory pressure in Europe and a significant, unexpected shift in institutional sentiment, which creates a more complex and immediate challenge for the stock's upward momentum than most realize. The market broadly believes that Microsoft, with its deep integration of AI into its Azure cloud platform, is essentially immune to minor headwinds. This belief stems from the phenomenal performance in its intelligent cloud segment, which consistently delivers accelerated growth, a figure that has been further supercharged by the demand for its AI services, including the integration of its key partners' models. This confidence has pushed the stock to trade at a premium, with a price-to-earnings ratio above the software industry average, signaling that investors are paying up for the perceived certainty of its future dominance in the cloud and AI ecosystem. However, that high expectation is being directly challenged this week by two specific external forces that introduce material non-AI-related risk. The first and most immediate is the European Commission's recent action. We are seeing news that the EC has launched market investigations into cloud computing services by both Amazon and Microsoft under the Digital Markets Act, essentially probing whether these companies are acting as gatekeepers. This isn't just a slap on the wrist, it signals a regulatory environment that is actively seeking to curb the market power of the biggest tech players. For a business like Microsoft, where its Azure cloud is the absolute engine of its growth and future potential, any regulatory action that could force changes to its bundling practices, its pricing, or its interoperability could directly impact the intelligent cloud segment's margin and growth rate. This unexpected political and legal friction introduces a level of uncertainty that the market was not pricing in just a few days ago, causing institutional traders to pare back their positions and leading to the intraday dip we see today. The second factor is the subtle but very real shift in analyst commentary. We have seen a high-profile analyst downgrade the stock from a buy to neutral rating, citing that the economics of generative AI are potentially far weaker than assumed. This perspective is a direct challenge to the fundamental premise that has been propelling the entire tech sector, that the massive capital expenditure being poured into AI infrastructure will yield proportional, immediate, and high-margin returns. When a massive institution starts questioning the core profitability model of the AI trade, it causes a significant ripple effect, particularly among institutional brokerage clients who may use investment help resources like Schwab Intelligent Portfolios, or even those who choose to self-investing through an individual brokerage like Interactive Brokers or Fidelity. These institutions are highly sensitive to signals that could foreshadow a slowdown in corporate spending on these new AI services, even if demand remains strong. Analyzing the recent stock movement, this negative 2.54% drop today is not an isolated event. It follows a period where the stock had already pulled back from its 52-week high of over 555, indicating that a long-term top may have been put in around that level as profit-taking set in. The trading volume has been elevated over the last few sessions, often exceeding its daily average, which signifies not just passive selling, but active distribution by some major funds. The institutional activity from the last reporting period, while showing a high percentage of held positions, also revealed significant activity, with thousands of institutions increasing their stake, but also thousands decreasing theirs. This suggests a contested battlefield, where the biggest players like BlackRock and State Street might be holding or slightly increasing, but others are actively rotating out, perhaps anticipating a cooling of the stock's rapid appreciation. This technical picture shows a stock that is testing key support levels. The prevailing bullish structure is intact, particularly if support in the low 460s holds, but the journey to the next upside target will be much bumpier now, having failed to sustain the push past the 550 mark. This is where the tension between expectation and reality becomes critical. The expectation is that Azure's growth is unstoppable. The reality is that the stock's price is now dictated as much by regulatory fear and the sheer cost of building the AI backbone as it is by revenue. To properly frame what Microsoft Corp actually is for those considering their online investment strategy, we look at its three massive reporting segments. The first and most talked about is Intelligent Cloud, which includes Azure, Windows Server, and its GitHub and Nuance acquisitions. Azure, its public cloud offering, is the clear engine of current growth, seeing revenue increases that outpace peers, thanks in large part to the accelerating contribution from its AI services, including the integration of its key partners' models. The second is Productivity and Business Processes, which includes the foundational suite of Microsoft 365, Word, Excel, Teams, and the wildly profitable Copilot AI integration that is being adopted by enterprise customers, as well as LinkedIn and Dynamics 365 business applications. This segment is the stability anchor, generating reliable, high-margin, recurring subscription revenue that provides a financial cushion against broader economic slowdowns. The third, more personal computing, encompasses Windows, devices like the Surface line, gaming, Xbox and Game Pass, and search. While this segment is generally slower growing, the Xbox Game Pass subscription model offers another long-term recurring revenue stream, and its recent global expansion of the Xbox Design Lab through a new international partnership is a bullish move to strengthen its gaming ecosystem and global brand. Historically, Microsoft's past performance shows a consistent transition from a stagnant PC software giant to a cloud behemoth, a shift that began years ago and has generated stellar returns for those who utilize tools like Fidelity ETFs or practiced self-investing in the stock. Its strong balance sheet, which is a hallmark of any quality investment, is undeniable, and its free cash flow generation remains robust. The Q3 fiscal year 2025 earnings report was the last major catalyst that solidified investor expectations, revealing an over $70 billion in quarter revenue and an earnings per share beat, with Microsoft Cloud revenue climbing by 20% year over year. The standout number was the Azure and other cloud services revenue growth of 33% in reported currency, a figure that included a massive 16 points of growth attributed directly to AI services. This acceleration, which occurred even as some analysts worried about macro headwinds, was the reason the stock originally spiked. Management noted that the outperformance wasn't just in AI, but in the non-AI piece of the business driven by enterprise customer execution, which is an extremely encouraging sign of the underlying health of their core cloud migrations business. However, even in that positive report, the gross margin percentage for the Microsoft Cloud decreased by 3 points year over year, which management attributed to the impact of scaling the AI infrastructure. This subtle detail is the reality that is now catching up to the stock price. The cost of building out the data centers, securing the graphics processing units, and powering these AI models is colossal. The company is planning to double its data center capacity over the next 2 years, an expansion that will require staggering capital expenditure, which in turn will put temporary pressure on margins. The bull case still holds that the sheer breadth of Microsoft's software portfolio, from Windows and Office to LinkedIn and the Xbox Game Pass, provides an unparalleled distribution channel for its Copilot AI offerings. Every single enterprise user is a potential customer for a premium AI subscription. This recurring revenue model, combined with their dominance in the enterprise, gives them a defensibility that pure-play cloud providers might lack. For the long-term investment, this ecosystem is the key. The bear case focuses on the massive investment cost, the regulatory overhang, and the risk of a broader tech sector slowdown, especially if the current macroeconomic pressures persist. To gauge investor sentiment on this critical topic, comment below how much you think the total global capital expenditure on AI infrastructure will be in 2026. Do you believe the cost will finally temper the growth, or will the returns simply justify the spend?